Hey, good evening, everyone, or good afternoon, whatever it is. How's everybody?
Good afternoon.
Hi, how are you? Well, yeah, I hope you got my message that I sent right before the class began at 6 o'clock, right? You guys got that message, right? I hope you are. Oh,
Yeah,
as to re- good, yeah. Well, I got my internet back, so I was connecting through. Yesterday, I was connecting through my phone as the hotspot, and until I got this fixed. And if you use your phone as the hotspot, the data you easily max out the data. They only allow, like, I don't know, a very small amount of data for uh, hotspot tethering or whatever. Now, anyway, so. I see 12 people here in the collaborate. So let me quickly check how many are in today's forum. And, today, 03. Oh no, 03 is on the next page. Where is 03? What happened? Page 1. 802, 803. There you go. Okay, so I see 15 people here in the but again, 15 people in the discussion board, but only 12 people. That means three are missing. And I've been telling you, I check. So it's basically, for your own good. And if you just sign into the discussion board and don't attend the collaborate, uh, then that's not, you will be missing out on a lot of things. Of course, some people have already studied thoroughly with the my lecture videos that were pre-released. But I also, you see, I check after every session. That was yesterday, right? There was no login report. I check the login report and see how many, they were, how long. Of course, uh, it doesn't guarantee anything because if someone just logs in and just, stay, just stay logged in, but doing something else, then it doesn't prove anything. But eventually, it's for your own good. I mean, you're not doing this for me or for anybody else, but for your own good, right? So if you're missing out,
Professor.
yeah,
Okay.
that's your, yeah. I'm listening.
Um, I'm just going to say I don't watch the videos on Collaborate. I watch all of them on YouTube because they're all on YouTube. Just in case
Yeah,
that goes into our grade.
yeah. That's good. Yeah, because the videos are, um, some of the videos are already passed, right? Some of the videos are already passed, so whatever is passed, you cannot see. For example, I'm talking, financial statements. I don't think everything is already. Most of that must have been already grayed out. It's all grayed out already because they were pre-released and it's been more than 5 days. And whatever is passed, then you go to my YouTube channel. Okay. Now, anyway, so what we have to talk about today is basically, we did the income statement yesterday. So we now move on to the uh, balance sheet, right? So Also, before I go to balance sheet, just wanted to remind you. Just want to remind you that quiz one has been announced, right? Everyone is aware of that, right? Quiz one has been announced. It's not visible. I don't think it is visible yet. I don't know, but let's see. Quiz one instruction went out today, 12 a.m. But it's going to be available from tomorrow, and it's going to be due Saturday. So in the assignments folder, you don't see it yet. I mean, it's grayed out. I can see it. You don't see it, but it's going to be available from tomorrow. Okay, so please don't forget you have quiz one due this Saturday. Now here, so balance sheet, right? Again, you already know a lot about balance sheet. It's about capital structure, and balance sheet. So capital structure means how much of the total assets came from. Should I make it smaller? How much of the total assets came from debt, and how much of the total assets came from equity? So in our example, look at the total assets. Total assets, exact number is like 9.855 million, but suppose it is 10 million or even 100 million. If the total asset size is 100 million, where did it come from? And so total assets came from, that 100 million came from debt and equity. Equity is, in our example, like ignore this number because we assumed 100 million total assets. So 60 million comes from equity, 60 million, and then 60 million came from equity. That means 40 million came from debt, and that 40 million debt breaks down into short-term debt and long-term debt. Long-term debt, literally, that long-term debt is the like bonds or mortgage loan that mature in long term. Longer. So the maturity is longer than 1 year, and so the long-term debt is about $30 million. That means 10 million should be short-term debt. And another name, we call it also current, non-current liability and current liability. Current liability is short-term debt, non-current liability is long-term debt. So because it is long-term, it's going to be bond or mortgage. And then current liability is short-term debt, and it could, so the payment becomes due within 1 year, right? And therefore, it consists of accounts payable, notes payable, interest payment, accrued wages, right? So these are basically short-term payment obligations, right? Accounts payable is basically something we bought on credit. Accounts payable is something we bought on credit. So in other words, those are the invoices to pay. Invoices, right? Invoices to pay, because invoices, I told you before, invoices, short-term loan, practically a short-term loan that a seller gives to a buyer, right? they don't they deliver something, but they don't collect cash right away. They don't demand payment right away, but they send you an invoice stating, please pay within like 30 days, or if possible, if you pay within a week, that's wonderful. If you pay within 2 days, from the seller's perspective, that's wonderful. You are a great buyer. I mean, um, you may always wonder if you buy something on eBay. If you buy something on eBay, of course, the payment is instantaneous. Otherwise, how can you purchase? I mean, you cannot. Um, but even though it's supposed to be, the payment is supposed to be instantaneous, because you pay with your credit card, obviously, on eBay or PayPal account. You have your credit card there. So payment is instantaneous, but always then once you make the payment, then they say great customer, great buyer. The comment is great buyer. Fast payment. Of course, how if you buy something, then automatically it's paid with your credit card. Um, but in so I always wonder why would they say this? I mean, isn't it obvious? I mean, isn't it only natural that the payment is instantaneous? Um, but if you consider that from a B2B perspective, B2B, if it is, of course, on eBay, I don't think they do B2B business on eBay. It's possible, but if the vendor is also, supplying these, things, like cables, USB, cables, or if they are doing this business, I mean, they are a business, and if they are selling it to another business, it's usually it's B2B situation, and in a B2B situation, you don't see instant payment that often. You will the payment, they will send invoice, and if they get paid within 3 weeks, they are lucky. So anyway, accounts payable is our now you understand the invoices that were that we received. So we have notes payable. It's our promissory notes. We paid with our promissory notes. Uh, I probably didn't. I haven't got a chance to talk about the promissory note. Did I ever talk about the promissory note before? I believe I did. Uh, Promissory note, when we talked about the short-term bond, I said promissory note is basically an IOU used between B2B. I mean, you write your personal IOU is not honored by anybody but your family, right? Or close friends. Um, Even if you get it notarized, public notary, right? Even if you get it notarized by public notary, it cannot be used as a medium of exchange. In other words, it cannot be used as payment. Nobody honors it as payment. But within B2B, right? In B2B, they use promissory notes very frequently. And another name for promissory note is commercial paper. Okay, so commercial paper is short-term corporate bond, and in that context, I'm sure I believe I said I talked about um, anyway. Um, so interest payment is this interest payment is basically the same thing as, think about it, this interest is same thing as this interest here. The same thing as this interest here, right? So I said, because you have interest because you owe money. Now I hope you remember what I said. I hope you remember that um, balance sheet and income statement have two different purposes. They serve two different goals, and uh, income statement, the goal is profit, right? It could be positive or negative, of course. Of course, they would all want uh, positive. And then the goal of the balance sheet, I told you, is the capital structure, K structure. So I told you, since they have different goals, different purposes, there are line items. The line items that make up them, these statements are different. They are all different. But still, a lot of students confuse, right? Um, Even after taking accounting 122 or 222, they still confuse the line items between them. Um, but you shouldn't be confused with between these two. The line items that make up these two statements are all different because they have different purpose. But there are only two things that have that's appear in both, and those are two line items that appear in both, and that's depreciation and interest. These are common. Depreciation and interest, that's common between the two, but otherwise all different. Okay, so keep that in mind. And so what appears here must also appear here. This should be exactly the same thing. And look, you see here, I calculated the interest in the income statement and then I reflected it here, right? Just pointing to J27, which is this, right? So they should, there must be like concordance between the two. Concordance, they have to concord with each other. Concurrence, they have to concur with each other. Now, and then, so that's pretty much the composition of the current liabilities, and it's easy. Non-current liabilities, that's pretty straightforward. Bonds and mortgage. And equity is straightforward. It's basically you raised this equity of 60 million, right, by selling stock, right? So that's equity. Now, and then, so the total capital, total assets, total equity and liabilities raised is 100 million, right? Total liabilities and equities 100 million, and this 100 million is basically transformed. Now, what do they do with those 100 million? They use that to acquire physical assets or long-term assets or real assets such as plant and equipment, land and building, right? So they used 90% of their, right? So that's 90% of their total assets, because total liabilities plus equity is total assets. 90% of that for acquiring and purchasing plant and equipment and land and building. Okay. By the end of the year, there will be depreciation, because as I told you, plant and equipment, all physical assets, wear and tear. wear and tear with age and usage, right? So depreciation is definitely a minus number, negative, because it uh, deducts from the value of your physical assets. And then current assets. So if out of 100 million, 90 million was a fixed assets, then the other 10 million is current assets. Current assets, also called working capital, right? It's called working capital. Also, as well as liquid assets, because current assets are basically all liquid, meaning they can be easily turned into cash. So when listing the current assets, you do it by the order of liquidity. So the highest liquidity, cash and cash equivalents. And then marketable securities. Marketable securities are basically stocks and bonds. And these stocks and bonds are not their own stocks and bonds. Think about it. Their own stocks and bonds are held by shareholders outside, right? External shareholders, because I own Google stock, but I don't work for Google, right? I own Apple stock, but I don't work for Apple. It's all held by outsiders. I mean, that way, the market participants' capital, market participants' money flows into this company, right? That's why it is. Uh, so um, the stocks and bonds, right? And then promissory notes. Okay, here, once again, promissory notes. I believe I talked about promissory notes, so I'm not going to go, too far into that. But promissory notes and accounts receivable. So accounts receivable are something, the payments that you have to collect still. So, the payments still to receive. That's why it's accounts receivable. That means you haven't received. You haven't received the payment. But it's obviously part of the revenue. In other words, think about it. Um, so then if you think about it, isn't promissory note also accounts receivable? In other words, you received the promissory note. You received promissory note instead of cash, right? So until you collect it, it's still accounts receivable. So and then accounts receivable is literally accounts receivable looks like what would be the difference? I mean, promissory note is something you still have to receive. Accounts receivable is still something you have to receive. How are they different? Well, I told you when we did the current liabilities section, I said, accounts payable is the invoices we received, right? So we owe the payment, we owe the money. I mean, in B2B, very often the vendor or supplier ships the products to the buyer with only an invoice. In other words, the buyer doesn't make the payment when they receive the goods, but they just think about it. That happens quite often. If you in B2B, if you have an ongoing business relationship, you are a buyer and you have your supplier, you're constantly buying from them, so you don't pay every time you make that purchase. Instead, you settle it at the end of the month. You settle it at the end of the month, right? I mean, uh, they ship. So if I'm a computer manufacturer, I will need something like, I don't make, computer manufacturer doesn't make everything, right? A computer manufacturer generally just, assembles uh, the components made by or outsourced by them. I mean, if you are Hewlett Packard, Hewlett Packard doesn't build a computer. I mean, it doesn't make the computer from the scratch. They use Intel inside. They use Intel chips and motherboard, CPUs, all supplied by uh, smaller, manufacturers that make the parts, make those components. And so they are outsourced. All those and flat panel, the LCD panel, these things are outsourced. Keyboard and these things are all outsourced, right? And then think about it. So Hewlett Packard, assembles the computer with these, components supplied by their vendors, and then every time they don't pay every time they ship these parts because there's an ongoing uh, uh, supplier agreement or ongoing a distributor uh, or something agreement, something like that. So they only pay even if we received five shipments this month, we don't pay every time the shipment comes in. We just receive invoices and keep them on our file and reflected on our uh, balance sheet, and then make the payment, settle that account all at the end of the month or something like that. So if the accounts payable are invoices that we have, accounts receivable is our invoices, right? Invoices we send to our buyers or sent to our, right? That's accounts receivable. Okay. Then promissory notes are what? This promissory note, it's the promissory note we received from our buyers. The buyers paid not with cash but with promissory notes, and it's got maturity date on it, like 30 days, 60 days, 90 days. Of course, I told you, theoretically, it can be up to like 360 days, but that's only theoretical. In reality, nobody. It's like it's not only an insult, but it's like adding salt to the insult, injury, adding salt to the wound, or I mean, you are. It's almost like we don't care. Whether you die from the cash flow shortage or not. This is our terms. So in reality, nobody. If you do business like that, obviously you will uh, you will rack up very bad reputation. And Donald Trump has been known for doing business that way. Uh, but holding off, payment as long as you can. uh, so in essence, promissory notes and accounts receivable are all basically credit sale. Understand? They are all basically credit sale. So they are all credit sale. But the only difference is that the promissory notes is a credit sale we didn't initiate. We didn't initiate it. We're a seller. We're a seller. We didn't initiate it, but our buyer imposed it on us. Our buyer imposed this credit sale on us. We didn't want it, but they paid with promissory notes. So what do? We have to oblige. Isn't it right? Can a seller say, no, we only take cash in B2B? I mean, if it is a pizza, mom and pop pizzeria, um, you can say, we don't take credit card, we only take cash. And you can do that if you are a well-known tourist spot, really, right? Um, in Little Italy, or it, and the tourists are basically swarming the place, and you never, and those places, they can say, we take only cash. Still, the business is booming, right? They can have the nerve to say, we only take cash. And also, there's other side to that. Of course, if they receive only cash, right? It's hard to. I mean, there's no record. You don't have to keep record of the. You don't. You can. There's. It's hard to. If you try to cheat whom? IRS, right? It's hard to prove if you have, if you, all the businesses are, basically, cash. But anyway, in B2B, you can't say we accept only cash, right? So you'll have to, and especially the buyer is a more influential guy in the industry, right? You don't want to rob him in the you don't want to rob him in the wrong direction, right? You don't want to irk that, think about it. From a mouse, right? If you're a manufacturer of mouse, right? You don't want to rub the uh, computer manufacturer like Compaq or Hewlett Packard. You don't want to rub them in the wrong way, right? Because also Intel is a huge, chip maker, and chip maker is basically a supplier, because chip itself is not it's still a component, right? It will have to go into the computer or go into the car, go into the cell phone. So even though it is a part component manufacturer, Intel, NVIDIA, and TSMC, all these, foundries, or what they call foundries, right? The chip manufacturing, they wield a lot of power in the market because they are huge giants, and um, they can flex muscle. They have really a lot of clouds. Um, so if their buyer rubs them in the wrong way, of course, it should be the buyer that will have to be concerned that they will not get the chips. Um, so, uh, but in most cases, seller is relatively in a weaker position, and um, I probably talked about the difference between buyer's market and seller's market. Uh, if it is buyer's market, sellers really have to oblige, right? And then, so if they just, if they just stuck this promissory note uh, in our face, then we'll have to accept it. right? So it's buyer initiated. Promissory note is basically buyer initiated credit sale, whereas in accounts receivable, invoices are accounts receivable is the seller initiated credit sale. So it's like, you are a mouse manufacturer, and Hewlett Packard is making, 10,000 laptops. They have production scheduled for 10,000 laptops. So then for 10,000 laptops, there should be 10,000 keyboards or 10,000 mice that goes together with the or 10,000 LCD panel, right? And if you are the manufacturer of the keyboard or LCD panel or something like that, uh, you ship, you send out like 10 shipments. Each shipment is 1,000 units of it. You don't demand payment on site, right? You don't demand payment at site. At site, as soon as you see it, right? Upon the sight of it, right? You don't demand because, um, once again, you don't want to rub your buyer in the wrong way, in the wrong direction, right? Uh, so you just send the invoice, and please pay within 2 weeks, or say just nicely, please pay within 2 weeks, and if you pay within 10 days, we'll give you a 2% discount or blah blah, right? That's accounts receivable. Okay. So now think about it. It's easy to understand that cash and cash equivalents, marketable securities, promissory notes, and accounts receivable are all liquid assets, all liquid, right? They are basically in the form of cash, or in the form of commercial paper, right? However, inventory inventory is a little interesting, because is it liquid? Inventory is physical in nature, isn't it right? Physical in nature, because it's I talked about this. Inventory means raw material, goods in process, and finished goods for manufacturer. But retail, for retailer, inventory means all finished goods. I talked about this. So they are merchandise. They are merchandise. So they are physical in nature, but they are still classified as liquid assets in terms of assets in capacity, in assets capacity, in the capacity of asset. It is a liquid asset. Why? Because all these inventories can be turned into cash relatively, without too much difficulty within 1 year. Of course, it takes more time. I mean, inventory are not as liquid as uh, cash or marketable securities or promissory notes, right? Because they are physical in nature. But still, they can be liquidated uh, at most within 1 year, right? And you may have heard of business. You may heard of you may have heard of business type called business type called liquidator, right? Has anyone heard of the term liquidator before? Liquidator? Anyone?
Well, the way it sounds, I'd assume they're responsible of selling all the company's assets off.
No, not necessarily. Yeah, you can think of it that way, but liquidator means haven't you heard of lumber liquidators? Lumber liquidators. It's just the name. I mean, it's the company name. It's not. Lumber liquidators are basically lumber wholesaler, right? Floor, floor materials, floor wood for the floor, lumber liquid. It's just their business name, but I don't. But they just named it lumber liquidator because that makes them sound like a wholesale. Of course, they are. Uh, Nobody heard of lumber liquidator? You don't do any. You guys don't do any home improvement project. uh, and at your age, you don't do that. Uh, if you are, if you own a home and older, and you probably think about home improvement. But anyway, to raise the equity value of your home. Now, but the liquidators are a special category of business that do what? Um, have you guys ever been to a 99-cent store? Mhm. 99-cent
Yeah.
store? Yeah. Why are they 99 cents? Because everything is like 99 cents or dollar. Now they are, it's a dollar, $3. Um, sometimes you can see something like $2. But have you ever wondered how they can be so cheap? How they can be so cheap? Mhm. Of course, some of them are very flimsy. Some of those goods are very flimsy. But some of them are still very good. But how can they sell for a dollar? Because think about it.
They buy wholesale?
Hmm?
Because they buy wholesale
They buy what?
on wholesale.
Uh, no, actually, that means then the wholesaler sells it below wholesaler's prices below 99 cents. Uh, whole, so 99-cent stores are retailers, but if they buy from the wholesaler, then that's the wholesalers are really, 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 really uh, cheap. I mean, the wholesalers would not make it. They won't make. The reason is, think about it. Yeah. Uh, uh, what DeAndre said earlier is quite right. For example, uh, you may have seen some stores, retail stores, go out of business. Why? Because times are different. Nobody buys from store. Everything is Amazon. They buy everything on Amazon. Let's say, uh, and then so retail business has been on decline. You can't compete with Amazon, or you can't compete with Walmart. So neighborhood retail stores are on decline, and sometimes they go out of business. And when they go out of business, what do? When they go out of business, huh?
They file for bankruptcy.
Yeah. Basically, what they do is, they put it on fire sale, right? Like, liquidations. They say we liquidate everything. That means what? We are we are closing our business. So they also call it closeout sale or fire sale. I mean, if the business was on fire, so I mean, uh, uh, they lost everything in fire. So that whatever they can salvage, they want to, right, get rid of it by liquidating. How do I? Uh, so think about it. If um, some businesses, some businesses uh, fail and they go out of business, and then if it is retail, they will just put out a sign, close out sale, right? If so, retail. But if it is a not retail, but something like a factory, or something like warehouse, wholesale warehouse, and if they go out of business, then they have to get rid of all those inventory, right? Merchandise, which is uh, merchandise that uh, they were holding. Inventory. In other words, in generic terms, it's called inventory, right? So they have to sell that inventory. Then there are businesses that specialize in buying these inventory of the manufacturers or wholesalers, right? So they can buy it very cheap. That's why they are called liquidators. Okay. Of course, when you're saying a company is liquidating, what does that mean? They they are uh, the business, they are closing out their business. They are, so they are, selling everything off very cheap. So they are liquidating, meaning, they are turning all their inventory, which is their uh, liquid asset, they are turning them all into cash. So to turning them all into cash, they put it out at a very, very cheap price. Okay. Um, so why? So how did I come to this? I lost track of my train of my thought, but I don't know. How do I go back to? Oh yeah, I know this. By clicking on that, so back to. So that makes up, uh, so as I said, inventory is physical in nature, but they can be liquidated, right, within 1 year. So in that sense, it's part of the liquid assets. And then think about it. So assets, the liabilities and equity is the source of the capital, right? And then uh, total assets is the use of the capital. In other words, uh, liability, liabilities and equity is how the capital was raised, and then how assets are how that capital transformed into what that capital transformed into, right? So that's why they must balance out, right? That's why it's balance sheet. All right, so I think that wraps up everything about uh, so it's a good time to take a break. After the break, so we'll take a 10-minute break, and after the break, we'll fill in these blanks. I mean, mine is already filled in, but yours must be blank. So we'll come back in 10 minutes, and we'll start filling in these blanks. Right? Alrighty. So let's take a 10-minute. Okay. All right, we're back. We're back. So we're back now. So we're going back to now. Actually, we did everything. So we're gonna basically, clear out these. I mean, if you have. Okay. So I think this whole. Uh, so what does it look like on your Excel? Is it blank or is it filled in? Is it filled in or is it blank?
Mine is blank.
It's blank. So I'm sure I gave you a blank file. I must have given you a blank file, so it should be. Um, all right. Uh, so let's fill it out. Not the same color. Can I find? I cannot find the same color. Okay, that's fine. Doesn't matter. So hmm, can I? All right. So first of all, okay, it's not a difficult thing. I mean, uh, it's just a sum command because obviously total current assets must be sum of all of those, and if they are already expressed, um, we just all we need to do is use auto sum, and it's gonna sum everything above it, right? So hit enter. We got total current assets of 115,000, and then the rest of it is the same. One and the total non-current assets, you add them up. So auto sum. And one thing you have to keep in mind is the depreciation. Depreciation needs to be it needs to be uh, negative. It should be subtracted. Negative, because it reduces the asset value. And as I've been explaining this over and over, that depreciation is actually artificial. It's not so. If I ask depreciation, if I ask any student what's depreciation, a lot of them just give me like dictionary definition, right? Dictionary. Oh, it's the reduction in value. Why is there a reduction in value? Well, just dictionary definition because assets lose value over time. Why do the assets lose over value time? Now then, some students can answer, some students don't. The, if you think about what assets mean, it has, it's defined on three levels, just like liquidity. Assets first, um, uh, is defined as, of course, basic definition. Assets are uh, uh, liabilities plus equity. Yeah, of course, that's, it could be one of the definition, and that's, called accounting identity. And also that means from this you can tell assets all came from liabilities and equities, which is the source. That means, source of assets, and then that's why they should be balanced out. And then there's also two sides. These are like two sides of the same coin. Assets and liabilities and equities are two sides of the same coin, right? Because without liabilities, there can't be assets. Without equity, there can't be assets, right? Um, so you cannot say we'll have to increase our assets but lower liabilities. And they think that sounds like, assets and liabilities are two different things and they are opposite things. Actually, what you can think about it, if there's no equity, assume that there's no equity, right? And of course, if there's no equity, let's say there's no equity, if there's no equity, then all your assets are debt. All your assets come from debt. So if you increase assets, there's no way you can decrease liability. Isn't that right? If there's no equity, the only way you can increase asset is by increasing liabilities. You understand? So if you want to say, a better way of saying that should be, you can increase assets while decreasing liabilities. That's possible, but then by that much you should increase your equity, right? If you want to lower your liabilities but still want to increase asset, then that has to be picked up by equity. That's the only way. So that's how asset is. Another way asset is defined, and this is, what accounting will tell you. Accounting will tell you that, assets are what you own, liabilities are what you owe. Assets are what you own, liabilities are what you owe. Well, it's not too wrong. I mean, it's true. It's not entirely wrong, because by definition, liabilities are debt, so that's what you owe. But then assets are, yeah, that's true. But then what about equity? What about equity? Is equity what you owe?
No.
No, of course not, because equity is your own. I mean, your own capital. That equity is the capital uh, that you put forth. I mean, that you put on the table. So you cannot define it like, in terms of own or owe. So if you want to really define it, yeah, assets are what you own. That's correct. Equity is also what you own, free of debt, right? But then you can put yourself. I mean, that's when you are. If you think about it, that's when you are the owner of the company. I mean, as the owner of the company, I mean, put yourself. If you're, putting yourself in the shoes of the owner of the company, then assets are what you own, and equity is what you own, free of debt. That's true. But from the company's perspective, again, I told you yesterday or the day before yesterday that the company is not a person. It's not an animate object. It's an inanimate entity. A company is an inanimate entity, and company is only a vehicle, right? to channel the profit to you, to the owners. In that sense, it's like, if you are a farmer, and if you have an apple tree, if you're a farmer and you own apple trees, and the apple trees bear fruit, apple trees bear apples, of course, the fruit would be apples, then who does that fruit belong to? And I told you clearly, fruit belongs to the farmer, not to the tree. Make sense? Of course, you might say,
Yeah.
you can, that's, and just, if you think twice, you will understand. Because, it looks like the apples belong to apple tree, but apple tree is not like an animate, owner, right? Apple tree is like the company. Apple tree is the vehicle, right? So saying that the profit belongs to the company is like saying apple belongs to the apple tree. But again, anyway, even though the company is only a vehicle, it is a legal person, right? From the from the standpoint of the law, it's a legal person that the law can take actions against. So, so from the company's perspective, right? From the company's perspective, equity is what the company owes the owner, right? Equity is what the company owes the owner. Liability is what the company owes the lender or the creditor, right? So yeah, then it's settled, right? That's why they say, own or owe. That's fine. That's the second level of definition. Remember, that's the second level of definition. First and a second. Third, what is an asset? Asset must have income generating power. Assets must have income generating power, right? Assets must generate income. Asset must be something that generates income. So in other words, that's the same concept as capital in economics. Because in economics, capital means, physical capital. Physical capital generates, it produces something. Of course, financial capital can also generate income. Isn't that right? Financial capital, stocks and bonds, it generates, investment income. So if an asset cannot generate any income, it's a obviously non-performing asset. Non-performing is not. So that's the definition of an asset. And then why did I bring it up? I brought it up because where was I? So far, because of depreciation. Okay, because of depreciation. So all, especially physical assets, physical or real assets or fixed assets, they wear and tear with usage, right? And with age, right? The age means, the usage, with age, usage goes up. So they wear and tear. Wear and tear should, right? Wear and tear should lower the value of those assets. And it's not because of only external wear and tear. There's some, there are some nicks and dings on your car, external, right? External imperfections, but still the car may be running like new, right? But that's an exceptional case, because in reality, production equipment, physical assets are production equipment, like plant production equipment. They cannot, if they have wear and tear is due to usage. So production equipment, if they have wear and tear, of course, the value of the production equipment must go down. That's depreciation. That goes without saying. But it also means the depreciation of the production equipment means lowered production capacity. Isn't that right? The production capacity, lowered production capacity. It's only natural. Suppose you have, you buy a new AC. On day one, I mean, in the first summer, the AC works really, really, really fine, really well. I mean, it's quiet. It runs as if, it doesn't even exist because it's very quiet. And it cools down the room in a second. And it uses very little electricity. It's not fuel economy. What should I call it? Its energy efficiency is very high. That's in year one. But with usage, think about it. 5 years later, you start noticing, noise. Before it was very quiet, but it makes some clunking noise now. And then the room, 5 years ago, it cooled down the room in a split second. Now it takes like 10-15 minutes to feel some crisp coolness in the room. 10 years later, think about it. It will make a lot of noise. It becomes a clunker, right? It makes a lot of noise, and it doesn't really. You don't really feel cool, whether it is, and then the energy bill, you receive the energy bill, right? You receive the energy bill, and it's a lot. Why? Because the energy efficiency of that machine went down. That's all due to wear and tear. In other words, the production capacity went down. So depreciation means not only, production capacity, lowered production capacity. And so think about it. No one, if you're a manager, no manager will let that go on. No manager will let that go on. Think about it. Why? Because reduced depreciation means reduced production capacity. Reduced production capacity means we are falling behind our competitors. And in a market, in a very competitive market, if we are, if you are falling behind in output capacity, that vacuum is picked up by our competitors. That means our market share will shrink. Does that make sense? So no management will let their production capacity go down. In other words, as much as it is depreciated, they will do what? They will replenish or replace or replenish or even expand. Replace what? Replace the worn and torn. Replace the worn and torn portion of the production equipment, right? Or replenish, replace and replenish, the same thing. Replace the worn and torn part, and then, or even expand. So if you just replace, then production capacity will be maintained at that, same level, constantly at, 100% level. If you expand, your production capacity, doubles, or it goes up. And then, or the third thing you can do is completely, a new venture. You go into a completely new venture. I mean, you let the so think about it. Your company has one of the product lines of your company is the bicycle, and the bicycle falls out of, these days it's not, but let's say bicycle is phasing out, it falls out of popularity. So let the bicycle production line just depreciate, and we go into a new venture. right? So that's one thing. And another thing, this is really important. Depreciation is really artificial. Why? So think of it this way. Um, Depreciation is artificial for business asset. Artificial for business asset. In other words, what that means is uh, your car is not a business asset. Your personal car is not a business asset. Your personal car is for your own, commute or running errands or, weekend drive, joyride. It's not used for business. But for business, the vehicle, the car that the company has is a business asset. Why? Of course, the company car could be trucks or, for, making deliveries or picking up, something. But, even a passenger car like sedan, uh, you know, company can have like, BMW something, but it belongs to the company, or Mercedes, or Mercedes, Benz, but these cars are used for what purpose? When we have a important guest or buyer visiting our company, then you send out this car to the airport, pick them up, you chauffeur them around, and so they serve these cars serve to generate income. Isn't it right? That's what a business asset is supposed to do. They generate income, right? They may not directly generate income, but they serve to generate income. So it's a company asset. So then they depreciate uh, according to an artificial schedule. Now, your personal car, they depreciate too, but that's not something. I mean, do you have your income statement? Do you have a balance sheet? I mean, as an individual, do you have balance sheet? Do you keep track? Even if you do, you can do that. You can keep your own income statement, and but uh, you cannot claim uh, tax benefit or tax exemption, or tax shelter on your personal car, right? Because it's not business expense, but the expense to maintain, upkeep, and maintain this car, uh, uh, the business, the cars that the business has, uh, insurance, right? Insurance, maintenance, and fuel. All of this, the expenses. This expense is business expense, right? And think about it. You know what income statement is. In income statement, income statement, income, expenses, and we know expenses. There's CGS, and OPEX. The expense to maintain the vehicle, right? Insurance and fuel and maintenance, all that is part of this operating expenses. It's part of the operating expenses. So anything that increases our expenses, will reduce our EBIT. Does that make sense? Anything that increases our expenses will reduce our EBIT. So if EBIT is reduced, right, of course you'll have to pay interest. Then that also means EBT, earnings before taxes or taxable income, also goes down. And what I'm saying is, if it looks, I mean, if this is if this looks bigger, I mean on the income statement, if it is if it looks, or if it is recorded as bigger than it really is, right? So our taxable income goes down by more than it really should go down. But as taxable income goes down, that means if taxable income goes down, that's taxable income. If it goes down, what also goes down? If taxable income goes down, what also goes down? Anyone? If
Taxes you have to pay.
Yeah. What?
The taxes.
Yeah. Tax. So, who said taxes? I understand one is DeAndre, and who was the other who said taxes?
Isaura.
Isora. Okay, Isora. DeAndre and Isora, you guys are getting 0.5 for that answer. So, yeah, as taxable income goes down, taxes go down. That way, that means, you can save on taxes by making this look bigger than it really is. And so think about it. So you bought the company car, let's say it's BMW, whatever, 5 something I, 5XXI, whatever. I don't know how much it is, but years ago it was like 50K, I think. So the company, so think about it. If the company bought this car, there are 2 ways they can pay for it. Isn't that right? They can pay for it either by cash, lump sum cash, right? Lump sum. Or by credit card. Or, credit card, it doesn't, or by financing. In other words, by loan. Credit card is, suppose you, also, let's consider credit card as well. But, it's pretty much, it doesn't make any difference. So let's not. So if you paid cash, right? So in year 1, time 0, time 1, time 2, time 3, time 4. Because this happened in year 1, right? Your 50K will enter your balance sheet and income statement simultaneously, because this enters the balance sheet as asset. Isn't that right? This enters your balance sheet as company asset, as fixed assets. So it increases the asset value. Asset goes up by 50K. But then on the matching side, in the balance sheet, not the balance sheet, but the income statement, you paid 50K. So it's expense. You paid 50K for the car in year 1. So this increases the expense by 50K. Isn't it right? And if it increases the expenses by 50K, that means it will decrease EBT by 50K. Isn't it right? Doesn't it make sense? So they want to, yeah, because the company wants to write off this expense in year 1, so it reduces the taxable income by 50K. So then, accordingly, taxes will go down. But then, here's the thing: it's not just this company. There will be, thousands of businesses that buy cars, right? That buy the thousands of companies that buy cars in a particular year, right? They will all write off this expense in their income statement. I mean, it's not just one car. They will buy, some companies will buy, like even a fleet of cars, or all of that will reduce their taxes. And think about it. None of this, and there is no way. None of this. I mean, who will be very concerned about this when taxes go down? Who gets very concerned about it?
The IRS.
Government.
Yeah, the IRS. Who said IRS?
DeAndre.
Andrew Cole, and I say government.
Yeah, who said government?
Me, Isaura.
Okay, yeah. Yeah, it's government, but specifically, IRS. Yeah, why? Because IRS will have to collect taxes. And the taxes are basically the income for the government, right? And for the next year, I mean, think about it. They will have to budget. They will have to plan or build the budget for the coming years, and it's based on the tax revenue. But none of this was expected, isn't it right? When companies they buy car at their whim, isn't it right? They don't get it approved. I mean, they don't have to report to IRS. They don't have to get approval from IRS. So IRS has no idea. And suddenly, at the end of the year, they all want to claim, this. They all want to write off this as expense, and then suddenly, unexpectedly, the tax revenue is so unpredictable from IRS perspective. So they don't want this. So basically, they want you to do what? Oh, instead of writing it off in year one, spread it over like 5 years. Spread it over. Then in year one, don't write off 10K. Year two, 10K, 10K, 10K. So this way until year 5. In other words, they want to take out this surprise factor, right? If they all write off this expense in year one, the IRS will be hit by this huge surprise factor, and then they cannot plan anything. They cannot plan the budget. They cannot budget for next year. So but if they do it like this, think about it. What does that mean? It has not so at the beginning, at time zero, think about it. At time zero, book value of the at time zero, book value of the asset at time zero was 50K, because that's at time zero. You just bought it, 50K. 1 year later, at time one, it should be 40K. 2 years later, it should be 30K. Isn't that right? And so on, until it is fully depreciated, right? Until it is zero. But usually, it's not zero. They generally, have some salvage value, meaning, scrap metal value there. I mean, unless the car completely turns into dust. I mean, unless the car completely disintegrates and turns into dust, even if you roughly handle the car, I mean, if the car crashes and gets totaled, think about it. Even if the car crashes and gets totaled, there still is what?
Price.
No. Yeah. But what kind of price? I mean, huh?
Still value. Still value.
There is scrap metal value. Scrap metal, isn't that right? When if the car it goes to the junkyard, right? If the car crashes and gets totaled, it goes to the junkyard, and still the scrap metal, $200 maybe, whatever. There's still scrap metal value. I mean, so at the end, of year 5, if it is fully depreciated, then it should be either salvage value or zero. Salvage value is just nominal. But here, important thing is
Pressure is devaluation too. Also,
what?
devaluation. I don't know if I pronounce right. When something is start from the top and then end at the end at zero. Is
Yeah.
devaluation.
But did you say devaluation?
Yeah.
Oh, yeah. You can say it's a devaluation, but we have the term for that, depreciation. We already call it depreciation, right?
That's the word. That's the word.
Yeah.
Appreciate.
Yeah. Look, but then think about it. This depreciation is really, really artificial. Why? Because 1 year later, will the car value drop exactly by 10K? 2 years later, will it drop exactly by another 10K? I mean, is it really like that? Huh?
No.
Think about it.
Yes. No. Yes.
Yes? No, it's not like that. Look, if you have a car and your car is 5 year old, you've had this car has been 5 year old or what, you put it on the resale market. Let's say you try to sell it. What is the value? I mean, in reality, it depends on the mileage, right? If you have a lot of mileage, I mean, 5 years probably. If you have 50,000 miles on it, still, and the price you pay 50K for the car, but still, if you have taken a very good care of the car is in good condition. The reality is the car is in good condition, and then if you have changed oil regularly, rotated tires, changed tires, and if you're taking a very good care of the car, and if it has low mileage, it will still sell for about $20,000 at least, don't you think? Or $20,000 to $30,000, right? If you have taken a very good care of the car and low mileage. But the company car is generally well taken care of, because usually a company has a motor pool. Motor pool has mechanics. I don't know if they do anymore, but in the old days, all the companies had motor pools, and they had mechanics and their own chauffeurs, and mechanics take very good care of the car. And the company cars generally have low mileage. So in other words, 5 years later, what do you see here? 5 years later, it doesn't turn into scrap metal. Do you understand? It doesn't turn into scrap metal. It turns into scrap metal only if you handle it very roughly, drive it recklessly, and crash the car and total it. Then it turns into scrap metal. So in reality, after 5 years later, it won't be zero. Make sense? The reality is not like that. But on the book, meaning on the balance sheet, they depreciate all the way to zero or to scrap metal value. Why? Think about it. That's why I'm saying depreciation of the business asset is artificial, because it doesn't reflect the reality. Reality is the company car, after 5 years, they probably sell it in the market for 25K. They can sell it. But on the book, they should be declared 5 years later as zero, or the value of scrap metal. And why? Why do you think it is the case? Why? Think about it.
Taxes.
Does anyone have
Taxes.
taxes? Yes. Who said that?
Me.
Who is me?
The guy with the cat on it.
The guy with cap. Look, this is. I only see the this whiteboard. I'm not. I cannot see the blackboard.
Mine.
So I cannot.
Jesus Martinez. Yeah,
Huh?
right. Yeah, you can't.
Okay, Jesus Martinez. Okay, Jesus. Okay, I'll give you one. That's the answer that hits the nail on the head. Because think about it, they want to claim all of this as expense. They want to fully claim 50K as taxes. They want to write off 50K fully. What kind of company would, what business would only, think about it. The reality is their car is still good, so they sell it for 25K. So that means, does that mean they will only claim 25K, the other 25K as for their tax as expense? No, they won't. I mean, no, nobody will be that fool. Nobody will be such a fool to. So that's why I'm saying it's all artificial, right? It goes by the artificial schedule, and all the business assets will end up. So this is called, final book value, final book or ending book value. The ending book value will all be 5 years later. It should all be zero or just the scrap metal value, right? That's the thing. That's the thing about the. That's the thing they don't tell you in accounting class. I don't think any. They will only tell. Oh, depreciation is, because the assets depreciate. Yeah, why assets depreciate? Wear and tear is wear and tear. But again, the other side of that is taxes. They want to, because IRS doesn't want you to. No sovereign government wants you to write off this in year one, because that's going to be so much shock to the government budget. So they want you to spread it over, like, over 5 years or 10 years or something like that. And so there are all assets have different. That's called service life. Service life. All assets have different service life. There are like several service life category: 5 year service life, 10-year service life, 3 year service life, 15-year service life. Assets all are classified into different service life years. Okay, so we that's all the time we have today. So we didn't really finish this, but that's what the depreciation is all about. So we're gonna. I wanted to wrap it up today, but we have very little left. And interesting thing is, if command. I showed you what we can use if command for adjustment account. So maybe first hour tomorrow we can wrap up everything. All right. All right. So that's it for today. I will see you guys. I mean, if you have any questions, please email me. If you need, my Zoom office hour, still email me to schedule an appointment. And otherwise, I'll let you go. So I'll stop recording. So have a great evening, everyone, and I will see you all tomorrow. Okay?
Thank
All right.
you.
All right.
Thank
All right. You're welcome. Good night, everyone. Stop recording.